Well, welcome everyone. I am Bill Harris. I'm CEO here at BIP Wealth, and just a beautiful night tonight. Fantastic to have so many clients and so many friendly faces show up this evening. So usually like to make a couple of comments before we bring up Eric Kramer, our Chief Investment Officer, to talk about the quarterly market report. As you can see behind me on the inside page of the presentation, usually have some comments, and just wanted to make reference that during the first quarter, we brought in 4 new employees, team members at BIP Wealth. We brought in a Chief Technology Officer by the name of Duncan Meredith, who's going to oversee our software development team, onshore and offshore. So we're happy to have Duncan join us. We also brought in Katie Upchurch and Tyler Madison. Those are 2 relationship managers. Katie is going to be working with our very own John Ray. Raise your hand, John Ray. Yes. Hey, Johnny Ray. And Tyler Madison is going to be working in my practice along with Andy Bunch. And so we're excited to have Katie and Tyler both join us. And then the 4th is Jacob May. Jacob May is a former professional baseball player. He is going to be working out of Columbus, Ohio, so give us a little more geographic disbursement. But he's going to be focused specifically on professional baseball players. And so we continue to grow the firm, and a lot of it is in great gratitude of all of you that are in here. The introductions, the referrals, we really appreciate the opportunity to work with our clients and also the people that you associate with that you want to introduce to BIP Wealth. So thank you for doing that. With that, we'll go ahead and turn it over to Mr. Kramer to talk about the markets, which not exactly rainbows and unicorns right now, but I'm sure he's got some really good information to share.
I'm going to do my best. Thank you, Bill. Thanks, everyone, for coming out tonight. I do have a quick question. How many folks have only been a client for less than a year, if you don't mind? I think I saw a fair number. Okay, so normally this quarter is wraps and some chips and a smoothie. Okay, so this is different. What happened was we got through the pandemic, or so we thought, and we went from just doing Zoom meetings to doing things the way we used to. And the way we used to is in January, we'd have what we would call the annual market report, and we'd have a big dinner in Buckhead and a big dinner in Alpharetta, but we found ourselves 90 days ago just doing webcasts again, right? So we had to take a bit of a step back, but we had planned to do the big annual market report, having the dinner here at Ruth's Chris and so on. So even though it's technically just a regular old quarterly market report, we thought, especially if some of my predictions about the market are going to come true and everybody's going to be stressed out, at least we could have some wine and some beer, and they're going to keep serving through the whole thing, right? You might even want to have some for the very end because it kind of goes downhill at the end, you'll see. But and some great food. So there might be a few things I say tonight that get a little bit scary, but I'm actually going to show you that we've got a plan for how to deal with what we're going through. So, but I'm glad that you all could be here and come out tonight. There's restrooms over there right across the other side. The wait staff is here to take care of you. What we have learned is that even though our clients for the lunches demand tropical smoothie cafe, and those of you that have been here for a while know that because it's bought a lot of second homes and boats and all that stuff that newer clients might not realize. We also have a very loyal following we've built up now for Ruth's Chris. If we ever have one of these and we went somewhere else, we would certainly hear about it. So Tropical Smoothie Cafe is at the top because of all the money it made people, but Ruth's Chris as a place to come out is right there behind it because the service is great and the food is great and you all make it a great event. So thank you for coming tonight. Let's go ahead and kick things off here. There's 3 parts to the presentation tonight. I'm going to start with the key themes. And this concept of some key themes for the whole year is a little bit new for us. In 2021, we had some key themes. Remember, we're the firm where if you ask us, what's the market going to do this year? We're like, we don't know, right? It's all, hard to predict. Who knows for sure? But in 2021, we got very specific. And we started going over what we thought the stock market was going to do, what we thought the fixed income market was going to do, and a few other things. And we pretty much got it right. So we thought, well, let's see if we can extend that record a little bit. I'm sorry to say that so far it's been right for 2022 as well. But we're going to get into those key themes here in a minute. Then we're going to do the market recap. We're going to talk about really what happened in the first quarter. We'll talk a little bit about how those trends have continued, but we're going to talk about historically the context. How bad is bad? How good is good? We'll just sort of try to give you some understanding of how the first quarter fits into the long term. And then what I think is the most interesting part of the presentation, we're going to talk about the outlook going forward. And the outlook going forward has a little bit of a scary headline there. There's no place left to hide, although somebody told me that on the front page of the Wall Street Journal today, that was also their headline. So I guess they got spies that are showing up and finding out what's about to happen from us. We'll see. At least they stole our headline. So let's go ahead and jump into this. Here we go. Hold on there. All right. There we go. Whew. Haven't had a major technical failure in years. Glad we don't. I think that we just had a hiccup there. But let's start with these key themes. And again, we released these 90 days ago, and unfortunately some of them are coming true, maybe even more so than we'd figured. The first is this idea that stock markets will struggle. And they've been struggling. Had a pretty bad day today. The Dow was down about 650 points. Tech stocks continued to get hammered. Why? The pandemic, monetary and fiscal stimulus is done. When we went into 2021, every part of the federal government was trying to stimulate the economy. I mean, I don't think the stock market could help but go up. But that's really over now. Okay, it's ended. And so now all of this pricing power and everything that we were seeing in the markets has been withdrawn. So it's kind of natural you'd see some profit taking, but really we're into a new era. So we thought that the stock market would struggle, and indeed it has. We also said that public fixed income will suffer. Not struggle, suffer. That's a little bit of a harsher word. Why? Because of the Federal Reserve. We've got a runaway inflation problem. I'll get into that in a bit, but I don't really care what the White House has done. I don't really care what Congress has done over the last few years. I'm going to lay some blame squarely at the feet of the Federal Reserve for this. I'm predicting extreme volatility at any time, and today doesn't count. A 1,000-point drop doesn't count. I'm talking about get emotionally ready for maybe a couple thousand points drop in a day, maybe 5,000-point movement in a week. Maybe. Now, volatility mathematically can be up or down, and I think that there's a possibility that a few things happen and it goes up. But it's been a long time since we've really had to deal with that in the stock market. But I think that it could be coming our way. So I'm going to help us to get prepared for that and talk about what we'll do when it happens. I have a line in here about taxes only because we had a line in here about taxes last year, and it's the thing we got wrong. We thought taxes were going up last year for sure. But they didn't. Part of that was because the legislation that was proposed had so many technical flaws to it, we just couldn't believe some of the details that we saw. So politics aside, whatever side you're on, I don't care. This had a lot of problems with it, so it didn't pass. So some people would say that a lack of a tax increase is a good thing, and in the short run it might be. In the long run, it's kind of a bad thing. I'm not going to show you pictures of the national debt. If you come to these things regularly, you know what that curve looks like, right? It's not good news. But I don't think tax rates are going up this year. Nobody really wants to pay, now more than ever with the stock market coming under some stress. And then lastly, private markets can play a larger role. We're all familiar with the public markets. We hear about the public markets every day. You can't really turn on the radio or turn on the TV, it seems like, without being exposed to what's happened. But private markets can be very mysterious, but can offer a lot of advantages if you can deal with the illiquidity. So we'll touch on that in a little bit at the end. All right. So let's jump into the market recap. And for every bit of data that I give you, I'm going to tell you what's happened since this, because this data all ended at the end of March. So I'm going to try to give you a little bit more context to that. So let's start with what did the benchmarks do, okay? So if you were a client in the first quarter, then on April 15th, you got an email. It says log on to our client care website. and you can see your own quarterly portfolio report. Here's how you did, but here's how you compare. Now, it's pretty hard to make a public market portfolio go up when the stock market goes down, right? So a lot of what we'll talk about is how did we do relative to the stock market. But here's what the stock market did, and here's what the bond market did. So we'll start with the top, and if you look at the first 3 months of the year, the bond index, the fixed income index, was down almost 6%. The global equity index was down about 5.5%. One of those was a really, really, really big deal. One not so much. If you've been a stock market investor for more than a couple of years, then being down 5.5% for the quarter is no big deal. You're used to a lot worse than that. Big movements in the stock market happen. That's the nature of investing in the stock market. Last year was a terrific year for the stock market. In fact, if you look at like the 3-year number, that's 13.5%. That's substantially above the long-term average and what we expect for the future, because we've had some really good years in there, some really great quarters. So being down 5.5% is no big deal. But you're supposed to be able to invest safely in fixed income and preserve your capital. And the fixed income index was down a little bit more than the stock market, almost 6%. So investors that wanted to be safe, if you vanguarded your portfolio, which is a term I'll use when you index, you're down 6%. What the heck is going on? Well, when interest rates are ultra low and you go buy a bunch of commitments, like maybe you'd gone to your local bank and bought a 3-year CD or something, and then the prevailing rate goes up, you've got a lousy deal locked in. In fact, I'll show you in a couple of slides what happens if you bought a 30-year Treasury bond. What happened then when you've got now a bad deal for the next 30 years, right? So there's tremendous volatility there. And it's been so bad, even if you get out to like, let's say, 5 years or 10 years, that's basically the rate of inflation. So now if you've indexed your fixed income for the last decade, your return after inflation was essentially nothing, maybe even slightly negative. You paid any fees, paid any taxes, right? So this kind of negative performance is really, really bad. So the numbers look the same, but dramatically different meanings. Here's a little graph I like to do of the big news events of the quarter. Now there's a funny little trend you might notice there. I put some headlines and I'm not even going to read them. Just trust me, the green ones are good, the red ones are bad. So when the good headlines came out, the market went down. When the bad headlines came out, the market went up. That is the twisted world that we live in now. Thanks again to the Federal Reserve. Because when we have good news, the assumption is that the Federal Reserve is going to continue to do the thing they've just started doing after talking about it for years, but they've just started, really, I'd say, doing their job for the first time in maybe 15 years. I'm going to show you exactly what I mean in a minute. So if we get some good news, they're going to do their job and fight inflation. Well, that brings down the market. If we get bad economic news, maybe the Federal Reserve is going to continue to do what they've done, like I said, for about 15 years, which is insure the portfolio of everybody in this room, of every investor. The Federal Reserve has been postured not to fulfill its congressional mandate necessarily. Stable prices, full employment, stable long-term interest rates. Those are the 3 mandates. Instead, they've been very worried about the value of your portfolio. Well, now that inflation has taken off, they're having to worry about other things. So if we get some bad economic news, maybe the Federal Reserve will continue to insure our portfolios for a while longer and not do its job, so the stock market goes up. So good is bad and bad is good. And that's a lousy way to try to come up with an investment thesis, but that's what we're stuck in now, because the Federal Reserve's actions over the last almost 2 decades have essentially taken over the market. They've taken over the market. So it's not really a free market, and maybe it never has been completely, but they're dominating the market now. So you can't draw a clear investment thesis on many days. You look at the news and then you say, well, what's this going to make the Fed do? And that's what I'm going to trade on. That's been going on again for 15 years. And part of what I'm going to talk about here a little bit about risk being repriced, that's the headline here. I'm going to assert whatever's worked for the last 15 years is not going to work now. If your experience as an investor is not more than the last 15 years, I think you've been fooled a little bit. Let's just buy a bunch of tech stocks. I think crypto might be included in that. When interest rates are incredibly low, it depreciates the dollar, but we've known that they were going to have to raise rates for a while now, and it's starting to happen. So let me go pick my tech stock, let me go do the crypto thing, let me do all this stuff. A lot of things that have worked are getting unwound with amazing rapidity. There's a very sort of old style of traditional investing that's actually doing much, much better. This has been 15 years since we've been in this similar economic environment, because about 15 years ago, the Federal Reserve raised rates for 17 meetings in a row. Kicked off the biggest value rally that we've seen in a long time. And that's happening right now, as a matter of fact. Let's get a little bit more granular. It's always fun when I get to show 6 green arrows. Unfortunately, here's 6 red arrows. And I'll give you a rule of thumb. Every number that you see in the first quarter there, U.S. stocks down about 5, international, down about 5, emerging markets down about 7. You can see real estate down about 4. Look at that, fixed income, like I said, down 5.93. Fixed income outside the U.S. not quite as bad. In the 6 weeks since that, basically all that has happened again. So if you want your year-to-date number, the rule of thumb, take that bad news and give it a 2x. So that took 90 days to happen, and then in the 6 weeks that came after that, it's all happened again. That's kind of where we're at right now. Now, when I predict volatility, and I'm going to make a positive case at some point in here, I promise, it can be to the upside. That's what a really good quarter looks like. You see there in the green? And that's what a really bad quarter looks like. You might notice the fixed income values at the end. There and there are new. So we did just set some records. At least in the last 2 decades, that's as bad as it's been in fixed income. And it's been that bad again in the 6 weeks that followed. So there's a very good chance we're going to set an annual record. Now, decades and decades and decades ago, we had a couple of quarters that were a little bit worse than we had in the first quarter, but we're definitely on our way to setting some records. If we look at the U.S. stock market, there is relatively good news there. Relatively, okay? So let's look at this part here at the top. You see a bunch of different returns. So again, if you just Vanguarded your portfolio, we know the U.S. market was down mid-single digits. But any part of the market that says value doesn't look so bad. And any part of the market that says growth looks pretty bad. So the growth stocks tend to be the biotechs, the techs, right? The online, even some tech hardware in there. Value stocks are the real boring stuff. Consumer staples, energy. Think of value stocks as the salary man that gets up every morning and goes to work and has the stable job, and maybe not quite so much upside, but quite reliable. And growth is the guy on commission that might get the big sale, but it's highly variable. Well, right now, boring is pretty good. Right now, stable is pretty good. Predictable earnings is pretty good. It also happens to be the case that value stocks tend to be the companies that own a lot of commodities. So they actually do quite well in an inflationary environment. It's where the oil stocks tend to sit, the utilities, again, consumer staples, they own stuff that goes up because it's kind of hard to invest directly in commodities. So for a lot of reasons, the value stocks didn't go down very much. And there's even some investment vehicles we'll put in portfolios that give us what we call our value tilt that are still up for the year. So it's not that we only invest in value. Again, we call it a tilt, but the value story is not so bad. If we look at international developed market stocks, it's the same story. The numbers are a little bit different, but there was parts of that market that were up, at least at the end of the quarter. So there's good news within the bad news. It's not great news, but from a relative perspective, it's good because we overweight value. It leads to a more stable portfolio. You can typically do more in equity with us than you might otherwise do in equity somewhere else where you're exposed to these other risks because it's just a little bit more stable. And right now it happens to be doing great. And the last time the Federal Reserve raised rates 17 times in a row was actually having to worry about some inflation. We had a value rally that went on for years. And everybody that would self-describe as a growth investor pretty much decided they were a value investor. So we've been there before. So if you're a student of history and you go back decades and looking at that, that does not seem unfamiliar to you. If we look at emerging markets, we see there's been a fair amount of bad news there. The story's the same. Value stocks, that's not too bad. Down a couple percent. Growth stocks down about 10, so that's far worse. So it's the same story worldwide. And if you want to look at what central banks have done, again, pretty much, it's similar. Interest rates similar. Inflation is everywhere. So that's not a surprise. Now, if we look at real estate, it wasn't too bad. U.S. did better than international. Real estate's about 5% of our equity strategy. So it helps to diversify a little bit. Sometimes real estate acts like fixed income because of its high yields. Sometimes it acts like stocks. It's kind of hard to tell which one it did this quarter, but it went down less than fixed income. And often you get a 3 or 4% yield there. So that's all the equity stuff. But here's the real story. This is fixed income. And there's a lot of data on this page, and I'm going to try to simplify it and tell you what I think is most important. And if you're watching CNBC in the morning, if you're watching Bloomberg, you're going to hear people talk about this stuff. And this is with the exception of maybe Russia and China, this is ruling the planet right now, right? This is dominating everything that's going on. This interest rate inflation situation is influencing everything around you. So there's this thing in the middle of the top here we call the yield curve, and there's this dark blue line that says, 6 weeks ago at least, if you buy a 30-year Treasury bond, you're going to lock in 2.5% per year. Now, I asked an audience about a year ago, if someone said, you're going to go buy a Treasury bond, a 30-year bond, what interest rate would you demand? I got a different number, so let me just ask. Federal government, 6. What percent do you need to invest for 30 years with the federal government? 10. Well, who the heck was taking it for 2.5%? The Federal Reserve. Because they could print money and they would buy the Treasury bonds no matter what the yield. So that's not a market by any measure that we normally use to talk about how markets work. That's one pocket of the federal government printing money and then using it to buy the bonds from another part of the federal government because they weren't collecting enough in taxes to pay for all the services, and so they needed to issue a bunch of Treasury bonds. And if they'll take any rate that's out there, turns out 2.5% was enough, whether it was a 30-year bond or a 10-year bond or a 5-year bond, or pretty much down to about 2 years. Now, there's something else in this blue curve that ought to be, I think, an embarrassment to the Federal Reserve. The curve should always be kind of smooth. What's happened is the Federal Reserve directly controls the overnight rate, which is almost zero. When you see that kind of sharp movement, that's the market saying the Federal Reserve is going to have to act fast. They're already saying a year from now, the overnight rate's going to be more like 2.5%. When you see that kind of shape of the curve, it says that the government is distorting the market, but it's going to have to stop. And the only reason you see that is because of failed policy. The curve should be smooth. The government should never be doing something that severe. That's the market saying, this can't last. This doesn't work. Academics, economists look at that and go, yeah, that's a sign of failure right there when the curve has that shape. Now, just 90 days before that, it was a little bit different. A year ago, it was a little bit different, but now it's moved to that. Because the Federal Reserve has been saying for month after month after month, we're going to fix this problem we created. And they haven't done it. Now, just in the past week, they raised interest rates. Now the overnight rate is 0.75%. And here's the market saying 2.5%. By the way, now the market's already saying maybe that's more like 3.5%, because it keeps getting worse because they're really not dealing with it adequately. The inflation problem is continuing. It's become embedded, as I'll show you. So there's a lot in that a finance person looks at and goes, oh man, that's bad. Now, even with where rates ended up here, and this is kind of hard to see, the government's long bond index, or the index of long government bonds, lost about 10.5% for the quarter. Rates went up a little bit for 30-year bonds. But when you've got a bad deal for 30 years, the price of that instrument is going to fall dramatically. So that's a 10.5% loss in 90 days. It's lost about that much again since then. So year to date, it's down, in more than 20%. So that's bad, right? Shouldn't be doing that. And again, all of these things here in red, that's supposed to be how you invest safely. That's a safe portfolio, all those versions of fixed income. But that's where we're at. And again, this is really the Federal Reserve, and I'm going to show you what they did here in a minute. But that's the past. Ship has sailed. You got what you got. It's all there in your quarterly report. But now we're going to talk about the why and what's coming and what explains what's already happened in the first 6 weeks of this quarter. So I'm curious. I know everything's digital. There's no film in those cameras, right? It's the modern age. It's all digital. I've got a paper straw in my drink. I mean, it's the modern age, right? Does anybody still carry cash in their wallet? Okay. All right. It just sits there, right? There you go. Well, if you pulled out all those dollars, a third of them are toddlers. A third of them are less than 2 years old. If you look at the money supply, it's gone up 50% in the last 2 years. A third of all the cash in your wallet is a toddler. It's not even out of diapers yet. It's walking, but it's new. It's very young. And let's remember how inflation works. The economy didn't grow 50% in the last 2 years. So you have a expanding economy. There is strength there, but you got 50% more money. And the relationship to goods and services to money is the price. But all of a sudden you got a lot more money, so the price has to change. There's more dollars attached to a relatively fixed, at least in the short run, amount of production. And when that changes, that's either inflation or deflation, depending on which way it goes. So the official inflation print that caused the cost of living adjustment to go up for Social Security last year was 7%. But the money supply has gone up 50% in the last 2 years. So I think there's more inflation coming. And that expectation for more inflation is a really, really big deal. A really, really big deal. First of all, you see it in commodities, usually immediately. Now, it's hard to invest directly in commodities, but if you have a stock market portfolio that's heavy into value, you know, you're going to own some ExxonMobil and Chevron Texaco and a lot of firms that own oil. Now, it is worth remembering that in the Great Recession, Goldman Sachs actually bought some tankers full of oil. But that's a pretty clunky way to get commodities exposure. Probably better to just own, you know, some value stocks. Famously, years ago, the natural gas market, the spot market price for natural gas went up. But when we invest in this, we have to go buy futures. So people would go buy the futures, but the future would get cheaper as it aged, even though the spot price was going up. So everybody was losing, you know, their fortunes in the futures market for natural gas, even as the natural gas price went up. And so I'm getting into a few details here that's worthy of a 30-minute discussion to give it its due treatment. My point is, you've got your commodities exposure with us. It's in the form of the value tilt. But this reacts right away to inflation, and I don't think the inflation is over. So good for our investors on a relative basis that we do this. But this, again, is just a symptom of the inflation problem that we've got. Retail sales have spiked. Now let's talk for a minute what retail sales are. This laptop computer is retail sales. That projector is retail sales. That chandelier is retail sales. These glasses are retail sales. This blue folder that's got a printed copy of your presentation is retail sales. Food, gas, cars, a lot of stuff. Almost everything is retail sales. You can exclude food and energy, but you can get into some different definitions there. And it's going crazy. Is anybody here looking to buy a car? Do you think that if you wait, it's going to get cheaper?
I'm praying.
That might be the best strategy out there because there's nothing we can do with math that's going to make it work. And what happens when people think that car is going to be more expensive next year? Maybe even, God forbid, that laptop's going to be more expensive, right? We think flat screen TVs always get cheaper, but a lot of technology is going to be more expensive. It's more expensive than it was last year. If you think it's going to get more expensive, you buy it now. And when everybody in the aggregate buys it now, retail sales spike. That is an unnatural rate of growth. It's rational for consumers to buy now because they're worried about inflation. Inflation is a great stimulator of the economy. And it spiked. I mean, normally we go through a recession and it goes down. We get back into the recovery. It starts to gradually recapture lost ground. Well, here was the big recession from the pandemic. It lasted 3 months. You can barely see that vertical gray bar. Retail sales dipped. They came right back, maybe because of the increase in money supply to some degree. And now they're going crazy. We are off our long-term trend. I mean, it's just easy to see when you look at the chart. But we didn't have inflation before. Really, it's been about 40 years since we've had inflation like anywhere close to what we're looking at right now. And consumers, in the aggregate, did the reasonable, rational thing. They accelerated their purchases because they expect the inflation to continue and there won't be that relief coming. So again, economists, finance people look at that curve and go, there's a market failure happening. It's not supposed to do that. When it's that sharp, something's going on, it's a big deal, could be a problem. Here's a whole bunch of data, but I'll just summarize it. International overseas shipping. You know, when you see the trains, remember in the pandemic, like the trains didn't run. If you live anywhere near train tracks, there was no trains. There was no jets in the sky, there was no trains on the tracks. They're full now. And a lot of it's those intermodal international shipping containers. They're on ships, they're on trains, they're on trucks. They're going away, they come back. The inland port that's being built out up near Gainesville's because of all that. Volumes are huge. So in 2021, global volume was up 6.5%. Some recession, huh? They can't keep up. They really can't ship anymore. They're out of ships. They're out of containers. Kind of nothing you can do. The ports are clogged. Now, some of the port congestion is eased on the West Coast. It's still kind of a problem in parts of the East Coast. But every part of the infrastructure is being challenged to move all this container traffic through because retail sales are just going crazy. So we reached a natural limit. Takes a long time to build a ship, takes time to build these containers. It's not easy to expand a port. So what does happen is that prices go up for shipping. Right now it costs 6 times as much, roughly, to ship internationally as it did 2 years ago. So volume was up last year 6.5%, it was up the year before, and pricing has gone up 6 times because we're at the limit. We really can't do any more. All we can do is raise prices till people stop shipping. Just can't increase the volume. That's inflation. That laptop was not made in Ohio, I'm sure. Nor that chandelier, nor those glasses, nor that piece of paper, for almost anything in here, right? So it's more expensive. Now, that does tell you there's some underlying strength to the economy. There's a lot of people that are going to still keep buying those cars. They're still in line to buy that nice new gourmet refrigerator for your house and, KitchenAid's, not even taking orders. They don't even want your order. There's such a backlog. So that's probably good news. No matter what happens, that's probably going to carry on for maybe a couple of years. There's pent-up demand. Okay? The average age of cars on U.S. highways now is as old as it's ever been, by a long shot. People can't get them. Single-family home construction. Took a little bit of a dip there, but it's staying strong. Total volume might dip, but it is my opinion that prices will not. I always love it when there's some home builders in the audience. Are there any home builders here tonight? Anybody in that business, or you're probably working is what you're doing right now, because you can't find the labor if you can even get the materials. One of the best moves that our client base could make right now is if you're in this situation, and we know some families that are, the older generation is here, the young adult generation doesn't own a home, can't find a home that they can afford that meets any of the criteria, but maybe that older generation has enough resources that they can help. You want to own a home right now. I think the prices are going to continue to go up. Volume of transactions, what we're reporting here, may dip because you can't find the materials and you can't find the labor. There's natural limits. And when price goes up, eventually at some point, maybe volume goes down. But it's a funny thing. If you're going out to eat and the price of something is suddenly more expensive, you expect demand to fall off. That's the supply-demand curve. When the thing you're buying is an asset, a rising price can make you be willing to pay more. So there's a difference in how supply and demand works for a good or service that can perish versus an asset. So we'll see what transaction volume does. But again, if you own a house, you were thinking about selling a house, you're worried, do I need to sell now because I think the bottom's about to fall out of the market? What happens when mortgage rates go up? Well, rising mortgage rates may affect it a little bit, but at least right now, I'm not seeing any signs that you need to get out of that house that you were thinking about getting out of. And if you're praying that that house is going to be cheaper next year, I don't think it's going to happen. So again, if there's somebody that you can help to get it, that house in the family, and that's your particular situation, I don't know, there might be two people here where that's relevant, do it. And when someone has asked me, what's the best move you can make in housing? You got a 30-year mortgage a year ago. Right? Because now that was 2.75% and now that's double. Because the best inflation move out there is to own an asset that you think is going to appreciate and to have financed it with somebody else's money that you're going to repay over 30 years at a very low fixed rate that can't go up. And if for some reason rates fall, you can refinance down even to a low rate. That's the best inflation hedge out there. So, for some people, paying off their mortgage may make sense if they've got the resources to do it. Maybe they own 2080 Media and they just, the exits just keep coming. They just got all this cash they don't know what to do with, right? You could, but, if you've got a fixed mortgage, that's a good deal. If it's 30 years, it's even better. If it's 15, it's not bad. If you've got an adjustable rate mortgage, begin to budget for what's going to happen to that. And if it's the younger generation in your family that has an adjustable rate mortgage, get ready for that to reset. Go read your fine print and find out what your cap is if you've got a cap, because that's going to start going up. I want to talk about the labor market for a minute, the employment market. This is not the chart I would normally show you. Normally I'd show you the unemployment rate. It's near zero, okay? This is something different. Actually, this statistic has been the subject of a lot of conspiracy theories over the last couple of decades, but I'm very confident in this data. Has anybody here ever gotten a phone call from somebody representing the Bureau of Labor Statistics, Department of Labor, trying to ask you questions about working? I can never find anybody that has, but they do this survey, I swear. And the call is something like this. Are you working? Are you employed? That's easy, yes or no. Although, if you're a baby boomer and you're a professional, I would contend it might have a little bit to do with the weather. On the sunny days, I don't work in them, you're a consultant, but not today, but then it's raining, it's windy, yeah, I'm working today, I'm in the office, trying to raise a couple more bucks doing some consulting, right? So, but it's the question, are you working? If not, are you looking for a job? If you're either working or not but looking, you're participating in the labor force. And so if you're 16 or older, 62.4% of Americans are in the labor force. Some of you here are happily retired. You're not in the labor force, no matter what the weather is, right? Now, if you look at the prime working age, that's 25 to 54, that's the red line, it's 82.5%. You got to be at least 25, you're sort of done with the college thing, your year off, you're all that, now you got to pay some bills, right? So you're in the labor force, you're 54, even if things have gone well, you're probably not retired yet because you don't know what else you do, so you're working. Those numbers dipped, now they've come back. Not quite to where they were before COVID-19, but they're close. If you're curious about a statistic that's dominating this part of economic research right now, there's about 11.5 million job openings in the U.S. I remember just a couple of years ago when it got to be more than 5 million. We're at 11.5. There's only just over 5 million people looking for a job. That's how extreme this situation is. But you know, we're actually seeing people come back into the labor force that a couple years ago were retired. It's called unretirement. Unretirement is a trend. The problem is this. Even if we get some more of this unretirement, there is a natural limit to the participation rate. And we're already there at the natural limit. So we get a few more unretirements. Maybe some employers are going to do almost anything to get you working there. We could get that a little bit above. Right, we were above it a couple years ago, right when COVID-19 broke out. We were above the potential rate as calculated by the CBO and some others. But you can't get much above and you can't stay there. You know, it's funny, when I remember doing the annual market report presentation when people are going, what's this COVID-19 thing I keep hearing about? And I'm like, I don't really know. You know, nobody really knew anything about it. And we were right there. We were above the rate. The economy was doing great. Funny thing was, the Federal Reserve had started shrinking the money supply and raising interest rates. And the stock market had a little bit of volatility to it. And the Federal Reserve reversed itself, began increasing the money supply and cut interest rates again, because we were still in those times that no longer exist, where everybody here had a portfolio that was being insured by the federal government. So it was really inexcusable. Now, we didn't know we were about to have a pandemic, so, you know, they really went nuts during the pandemic, right? But we're through that now. But my point is, you can't keep stimulating and really get it much above this curve, and it just doesn't stay there for long. That shows you kind of how accurate those numbers have been. So we're there. You can go a little bit higher. It's the biggest limit to the growth of the economy in the United States right now. We have a labor shortage. The median age of birth by mothers in the U.S. is now 30, age 30. The birth rate is lower. I had a question at lunch today, is immigration the answer? I don't know. I don't want to get into the politics of that. But you know what? We need workers at the top, at the middle, at the bottom. We need workers everywhere. I don't hear anybody complaining because they lost their job to somebody else. I hear people that are entrepreneurs, that are our clients, that are business owners saying, I shuttered my landscaping business because there's nobody to do the work. I can't go scale and be the equity owner and do something because I can't find any people. I can't go take my great idea to market unless it's software as a service or something and it's me and a couple guys with a laptop, but good luck finding that recently graduated computer science major. You better have the checkbook out to hire them, right? So, you know, we have a labor shortage. It's holding us back. Somebody else come up with the answer, but somehow we need people. What is happening, and it's less apparent, is those jobs are still being done abroad where the labor is. It's just we're back to outsourcing it because we can't get it here. It might be better to bring the people here and let them pay taxes than to just have it done. Globalization is kind of in retreat at the moment, but it'll come back. We'll simply help other economies to grow faster than us. That's why you ought to keep that international equity allocation. The U.S. looks great by comparison in many quarters, but as globalization comes back, that work's got to go somewhere else if there aren't people here to do it. So because of all the things I just said, we've now got increasing wages. Wage inflation, wage growth. Now, there's some really weird data here from the pandemic. That blue line was the average. It's kind of an interesting story. You see it going up and going down. When you see the average wage spiking there, that's because all the retail workers and restaurant workers lost their jobs, at least temporarily. So the average went up because those of us that could work from home were still working. So the average went up, but it wasn't good news. Then they eventually came back and in fact were being hired in droves, and so the average kind of went down. So just put your thumb over the blue line, forget that you're seeing that. Look at the green line, look at the red line. Wages are going up. And we get into this problem of expectations again. If you expect the car to cost more next year, if you expect the housing cost to be higher, and that might be renting, then you need to get paid more. If you need to get paid more, then the company that's employing you needs to charge more to protect their margins. That's inflation. And that's called an inflationary spiral. Every part of that just feeds the cycle. It feeds on itself. It just keeps going. So you could say that wage growth like this is a symptom of inflation, but it's also a cause of inflation because it's an input to production if you're the business owner. You're having to pay more to get the people. So there's a question of which businesses can protect their margins, and on the whole, most businesses are able to protect their margins. They're able to raise their prices enough to deal with their higher costs of input. That's inflation. They're able to raise their prices enough to protect their margins. So they're passing on their inflationary pressures to protect their margins, and the public is still buying because the demand for retail sales and other things is so high because we think there's going to be even more inflation next year, and then that's the spiral. So it's good news for stock market investors that margins are generally being protected. It just means that they're able to raise their prices. It just means that inflation is going to continue. And so we say it's embedded. I'm saying it's embedded. The Federal Reserve, until just a few months ago, was saying, now all this inflation is transitory. Honestly, I mean, I knew what the word meant the first time I heard it. I just don't think I'd heard anybody ever use that word, right? And they kept saying it's transitory. It's temporary. It's transitional. Anyway. They stopped using that. Eventually, after most credible economists said, you guys are crazy, enough months in a row, they said, we'll remove that from the language. Maybe it's not transitory. It's definitely not transitory. It's embedded. It's built in. It's baked in. So these are different measures of inflation. That's another 30-minute discussion right there. Which one do you like? Some of these use more substitutes. But price of butter goes up, you switch to margarine, is the way economists teach that. But it's all going up. And I remember when I was predicting inflation, somewhere back here, and I said, I got no inflation data to show you. There's no data that shows it. Just please give me 90 more days. I'm confident next quarter we're finally going to see it in the data. And then we started to see it, and now it's just taken off. And since it's not transitory, we can expect to see more of it. Now, I'm going to put up a little chart here. Some of you have seen this. Those of you that have seen it can groan a little bit because you saw it in college. Some of you haven't seen it. I'm going to simplify the world. I'm going to simplify my job. How do I see the world as an investment opportunity? So this is just a little graph, 2 dimensions. On the horizontal axis is risk. Now, all things else being equal, low risk is better than high risk when you're investing in something. A sure thing is even better. High return is better than low return. If anybody disagrees with me, you're in the wrong room, okay? So we have this thing called the risk-free rate. That's zero risk, it's risk-free, but it's usually pretty low return. That's put your money in the bank. You're FDIC insured, or you buy a treasury bond because the government's paying you back no matter what. It's risk-free. It's a low rate, but it's risk-free. Then you got the stock market. This is a 100% stock market portfolio out here, okay? Now, we can connect those, and if you're 50% in stocks, you're here, okay? Now, just because I had to make sure this was actually right, there's a way to make the line bow up a little bit, which is a good thing because you're getting a little bit more return for the risk you're taking. That equation goes from this end of the screen to that end of the screen. We're not going to get into that. That's what we're trying to do here. And you know what? When inflation is small, it's all fine. In fact, sometimes we don't even worry about inflation so much. Well, you do your financial plan, we got the inflation number in there. But from an investment standpoint, you can still invest risk-free and beat inflation. Now, you can take a lot of risk and beat inflation by a lot. Hey, over the last 3 years, the stock market was up 13.5%. What was inflation? I don't know. It was small. You don't even worry about it, right? That's the classic model. That's the normal model. We build portfolios based on that. But, again, here's the model, and here's where we're at right now. That does not look like as much fun to me. In fact, we used to have a name for this strategy for everything kind of right in here. It was low risk, low return. At least you beat inflation by a little bit. We call that capital preservation. Capital preservation. You're more concerned with the return of your capital than the return on your capital, right? You want it to come back no matter what, but a little bit bigger. But if you think about inflation, last year it was 7%. If you made 0.25% being in cash, what you really did was you locked in a 6.75% guaranteed loss. So guaranteed sounds good when you start the sentence, but you end with loss, and that doesn't sound good. So inflation minus the risk-free rate, or you actually have to compound it, but we'll just do subtraction for the moment. That's your guaranteed loss right now. So you don't want to do that with a whole lot of money, and you don't want to do it for too long. You better have some good plans for that money. I'm going to go buy that car. I'm going to make that next private investment. There's something else I'm about to do with my business, whatever. But if you do that for too long, you have a substantial part of your net worth that is guaranteed to lose money. And we call that the real return. The real return is after adjusting for the corrosive effects of inflation. So nobody can deliver capital preservation right now. Not us, not any other advisor, not Vanguard, not you on your own. Doesn't exist. It just doesn't. Thank you, Federal Reserve. Doesn't exist. That's what they took away. So when you hear about inequality in society, there's some people this affects more than others. But, it's probably getting a little bit worse because of that. I mean, we got all those great returns last year because we had money in the stock market, right? The Fed kind of helped us out. But if you're experiencing the 7% inflation and you're trying to keep your money safe, maybe you've got a modest amount of money. You really just need it to last. You can go to cash and lose that gap there. You can take some risk, but risk can be up or down. I mean, you got to get pretty far out there. You got to be like 2/3 in stocks to hope to keep up with inflation when inflation is this bad. So that's the problem. That's the problem right there. That's the problem we got to figure out how to deal with. So, we have what we call the toolkit. And there's a lot of things that we have in the toolkit, but let's start with what we all have, what everybody has. Cash. Depending on what bank you're talking to right now, maybe you can even get that over 1% if someone's aggressively trying to get cash for whatever reason. Just make sure it's FDIC insured, it can be in your money market. It's all a pretty low rate. And with inflation, you don't want to be there for too long with too much. There's public market fixed income. We already covered what those returns are looking like, right? That's no fun. Lots of volatility, low returns. And there's the stock market. Okay. We've all heard the expression out of the frying pan into the fire. Okay, what's your favorite asset class there, right? The guaranteed loss, the volatile low return, or the extra volatile, the Dow was down 650 points today. Now, you can do that. Vanguard can do that. If you're picking your tech stocks, you're actually down 25% year to date. Because that used to work. It worked for the last 15 years. I don't think it's going to work going forward. I think the tech stock crypto play is the last 15. I don't think it's the next 15. But anybody can do that. And that's a tough toolkit when you look at what that inflation environment was like. Now, we do an option strategy called Hedge Yield. It's not a miracle, but it's a fixed income alternative. by my calculations, which are not official, even after the fees, which are very modest, that's done about 1% better than the fixed income index per quarter over the last 12 quarters. So again, it's not fixed income, but it's a fixed income alternative. We do something called hedged equity, which is equity, but takes the edge off the volatility, the ups and downs. So it allows you to maybe do a little bit more equity than you would otherwise do because you're trying to not do some of this other stuff for the moment. We have private fixed income. Now, anything that's private means illiquid. Public markets are traded. Private markets are, for the most part, not traded. But if we all got together right here and we formed ourselves a business and we were successful, because it's the smartest table in the room, right? We're a successful business, absolutely. And we're growing. And we said, you know, if we had a little bit more cash, we could grow even faster. So we went to this group over here and we said, we want to borrow some money. That conversation, I know these people, it's probably starting at 10 to 12%. They want to make some money because they're concerned about inflation. So we can talk about a 2% yield, a 3% yield in public market inflation, but in the private market, the conversation again usually starts at double digits. And billions of money gets lent that way in very secure loans. But when you buy fixed income, you're loaning money, right? So for folks that can tolerate the illiquidity, live with that, accept that, you know, there's not much comparison between private fixed income and public fixed income in terms of what that does. And a lot of private fixed income is floating rate. Rates go up, the rate on the loan goes up. We have private equity. Most of the time it seems to work. Occasionally there are some failures. If you're worried about the failures, you might want to focus on making sure more of that's in what we call commingled vehicles, some entity that's doing 3 or 4 or 5 things, a fund. General partners get paid on the profits, so if there's any losers, but it's within that, they have to absorb some of that. I know there's a lot of details there I went very fast through, but again, if we hadn't had to do a Zoom call last quarter, we'd all be eating Tropical Smoothie Cafe, which we all love because people made so much money, but there's been a lot of other exits lately. In fact, one of the biggest problems, if you want to call it that I've got, is the CIO, is we've had so many exits from private equity lately. In some cases, investments that people were in for more than 10 years. There's all this cash on the sidelines and people going, what do? I'm like, well, I don't want it to be there too long. Let's figure out some combination of what's right for you. So when our advisors are working with clients, if Taylor's working with a client, he can use his very sophisticated, complicated software, but everything about the personal situation of that client into the software. When do they need money? When are they going to get money? How much money do they want to have left over when they're done with the money at the end of their plan, as the software says. And it'll help him figure out what gets the right amount of risk, the right amount of return, what ratio of all these things, how do they fit together? When there's a downturn, what gets hit the worst? Interest rates move, inflation moves, equity markets move. How do these things interact? It's pretty amazing stuff. And that's why every single family in here has a different investment plan. Because everybody's circumstances are different. Now, if we're not managing everything that you have, the hardest work I think that one of our advisors will ever do is go, well, what are you doing somewhere else and what's the strategy? And if you know what it is or you've got the plan, you can say, well, if we do this and this and this, then the whole makes sense. And that's work that we do. Is again, it's easy as an example when someone says, here's my $1 million or whatever, and we figure out the ratios of this, how does it serve your needs? But when you're doing other things, it gets complicated. We're prepared for that. But somehow you need your total, I think, to use all the tools in the toolbox that are appropriate for you. And it may be that illiquidity is not appropriate for you. Maybe that the stress of the public stock market is something you can only take in very small pieces. Maybe there's a reason that you need to be heavy in cash. Everybody's different. Every situation is different. The point is you want to have the plan because there's no place left to hide. Because it used to be that you could just load up on this, Because even if you weren't quite keeping up with inflation, maybe it cost you 1% a year. If right now it's costing you 6% a year after inflation, you want to be careful to just withdraw. You need a plan. You need a plan you can stick with. Things are going to go up. Things are going to go down. But you need to be in the game. So let's try to answer the final big question of the evening. When are the steaks going to get here? No, that's I know that is a question on people's minds, and there they are, by the way. I saw him coming. I saw the door open. Are we going to have a recession? Are we going to have a recession? Now, it turns out that the Federal Reserve will tell you when the next recession is coming. For all the damage that they've done, in my opinion, it's kind of nice of them that they have this. And it was really just a couple of years ago that I found out that they produced this statistic. It actually turns out to be pretty darn reliable. I got to admit, I'm impressed. And so I've really got two things on this chart from the Federal Reserve Economic Database, FRED, as it's called. The blue lines are the probability of a recession. The gray bars are the actual recession. So this is going way back. This is 4 decades. So when you see the blue lines start to go up, it says we're likely to have a recession. The red line is the stock market. Now that's pretty compressed. I'm giving you 4 decades worth of data. Let's go look at the Great Recession. A little bit easier to see. The blue line starts to go up before the recession. So there's actually some warning. Now, we got a little blip here, we got a bigger blip here, and then that probability went away. We didn't have a recession. So just going above zero doesn't mean we're going to have a recession. And it's not much warning, but you can see it beginning to go up here. Now, we actually come back and define the beginning and end of the gray bar. When's the recession after the fact? We don't know officially when it started. But it turns out we appear to get a little bit of warning. Now, the stock market will even go up and down, and a falling stock market doesn't mean that we're having a recession. But that's the Great Recession. My point is, there was a little bit of warning, but you can get some false alarms. But if you looked back at that other chart, and again, it's probably easier to see on your own printed paper, that's been the trend for every single recession. So right now, according to the Federal Reserve, the probability of a recession is 0. So that's the best I can do in terms of telling you, are we going to have a recession? I don't think so. Right now, we have a shortage of integrated circuits. Chips, right? Turns out that a new car, a gas car, has about 1,000 chips in it, they say. 1,000. It's one to make the window go up, I guess another one to make it come down. I mean, everything is just full of chips. Certainly the engine management systems are full of computer-driven functions. Turns out the average EV, electric vehicle, has about 2,000 chips in it. So a lot of people that would like to buy EVs but can't because there's a chip shortage. In fact, it turns out that these chip makers, these foundries as they're called, sounds like they're making things out of iron, right? But the little chips, they call those foundries where they make the chips. They use lasers in a lot of what they do, and these high-powered, super precise lasers use neon. And half of the world's neon supply for use in the lasers that make the chips comes out of Ukraine. And the 2 mines that produce all that are closed. That's going to lead to some inflation. It also means if you're hoping to buy that EV, you can't get one. Probably means that the next 3 or 4 years of EV supply, whatever they can come up with, is basically pre-sold. There's people anxious to get it, they just can't even get it. The market's there, the demand is there. If the situation in Ukraine gets resolved productively, this economy may have legs for years to go, satisfying that pent-up demand. China keeps locking down its major cities. Heck, most people in America already got Omicron. We kind of went through it, for better or worse. It was our country's real vaccination program. It was milder, spread like wildfire. More than 2/3 of Americans have had COVID, they think. China's been trying to stop it all, stop it in its tracks. I think eventually nature's going to take its course. I don't think they're going to be successful. At some point, China is going to be able to reopen because they'll get there too. Hopefully we do not get a more deadly variant, although there's news every day, I'm sure. And China comes back online, and that eases the supply problems. It eases some of the inflation. Maybe it's not all just up to the Fed to jack up interest rates to double digits. So right now, the Russian-Ukraine crisis, the Chinese COVID-19 crisis are making inflation worse. Those could resolve. If they were resolved positively, the Federal Reserve raises rates some, I could be standing up here in 9 months telling you how the stock market went up 25% in 2022, how we never had a recession. Again, there's a ton of demand built up there. The economy is super strong. Retail sales are going through the roof. There's a lot of activity. You know, we got 11.5 million job openings and barely 5 million people to take them. There's lots of room for slack there. Anybody that wants a job is still going to be able to have a job unless there is some absolutely phenomenally large catastrophe. So I know it's been tough, but it could get better. It's not all bad news. It's important to stick to your plan. I don't think we're going to have a recession. So let's just do the final thoughts. Okay? There's some key themes for this year. Your advisors are extremely well versed in those key themes and how to apply them to your portfolio. Risk is being repriced. Now, somebody before the dinner talked about their so-called play account, and I'll bet you there's at least a dozen of those in this room. I'm going to do my own thing. It's been fun. You know, I got to, say it's worked out pretty well the last 10 years, 15 years. Just do the opposite of whatever you used to do and maybe it'll still work out. But again, if it's the large cap tech growth crypto play, that might be the worst thing to do. And I know why it worked in the past, but I think that might be the reversal. So risk is being repriced. Basically go back to old-fashioned investing. There's no place left to hide. I get it why somebody needs to be in cash, but you can't hide there. It's not capital preservation. It's a guaranteed loss. Know why you're in cash as much as you're in cash. It needs to be a deliberate choice with a purpose. There's a lot of tools in the toolbox. If your advisor's been saying, we really ought to be talking about the benefits of that hedged yield account, let me talk to you about that again. I know you're frustrated with your fixed income returns. Maybe you've been hearing that message. Maybe you came to the dinner now and you're like, okay, I'm receptive. Tell that to me again. Let's talk about why we're doing this. And lastly, as I've said, at least according to the data today, we're not about to have a recession. So if that's your worry, if that's the reason you don't want to be on your long-term plan, the best data I've got for the moment is that that's not about to happen, and I promise to let you know when that changes. All right. There's our 2 offices, not counting the 20 people that work from home, right? So how about this? Everybody's got their food. Why don't we come back up and do the questions once y'all have had a chance to eat? Focus on your food, focus on the people that you're getting a chance to sit with. Maybe we'll let all that get done, and then when it's time for dessert, we'll bring out the dessert and we'll take some questions. Sound good? All right, thank you.
Thank you, everyone, for joining us tonight. Fabulous dinner, presentation. Eric, fantastic job. The servers, thank you. You guys did a great job. But before we wrap up tonight, we wanted to give an opportunity for some questions. If people have questions about what's going on in the market today, or questions about cryptocurrency, or whatever's on your mind, please feel free to raise your hand. Yep, we got our first question.
All right, here I am.
Okay.
I have a question for Eric. Eric, why did it take so long for the inflation to emerge when the money supply was going up so quickly for such a long time?
Sure, so the question was, why did it take as long as it did to see inflation finally emerge? And it is a great question, because a lot of what the Fed has been doing that caused inflation, they'd been doing for more than a decade before. So part of what was going on was that globalization was alive and well. And capital has a way of finding the cheapest sources of production for anything that we do. And so a lot of businesses in the US have been shuttered, famously textiles, furniture, but thousands of others, because somewhere else overseas it could be done more cheaply. So you had this deflationary pressure being exerted on every industrialized, Western, advanced economy out there. And so I think part of what happened is the Fed just kind of went crazy with what they'd been doing. I mean, they increased the money supply during the Great Recession, but I guess they just thought it looked like they had a free pass to do as much as they wanted. So they accelerated their policies, and then we had the pandemic, and globalization got shut down, and it was kind of the perfect storm to ignite this problem, this spiral that can be self-reinforcing. So it was a lot of things happening at once, but at its core was the Fed seemingly thinking that they could do anything they wanted. So you had them go into extremes, and then again, really, I do think it was the pandemic that kicked it off, that just was just the straw that broke the camel's back, however you want to say it, that really got this going. Now, again, can we pull back from it? I don't even know, but I think that's what happened. I think the retail stocks, the ones that are at the end of the distribution chain, depending on which one we're talking about, might be the ones that are having a little bit more of a difficult time covering their margins. They're most likely the ones that have the high labor cost. Maybe they're most likely the ones that are having some shortages of some things. So there's other stocks that are protecting their margins a little bit better. And those stocks, especially the ones that cater to the lower part of the socioeconomic classes, and that's not a judgment, but just folks of lower income, are expecting that those folks are running out of money. And so if you're selling to folks of very modest incomes, you might have a special sensitivity there. And some of the names that you mentioned, that's probably where they're getting a lot of their business from. Generally speaking, the folks that the businesses that are selling to folks in this room are probably doing better. Again, it's sort of a relative thing. Well, we do rebalance at some point into a dip. It is true that our portfolios haven't gone down nearly as much as the broader market. So for the most part, we're not there. We've done some proprietary research on when do you step in? And in fact, when do you take profits on the upside? And we were certainly taking profits for many of our clients last year. So yeah, there is a point where you step in, but our style is to be overweighted to value, and that hasn't come down so much yet. And I did get into a discussion with one of the other tables about how do we do that. And I'll say that the academic research, the literature on when do you rebalance, how often do you rebalance, is just the most embarrassing mess out there. A lot of academic research on investing is very sophisticated, and they know a lot of things that individual investors don't know. But when do you rebalance and how much do you rebalance is an absolute mess. It's just almost useless research. So we did our own research, and we look at the price of volatility, the price of risk, and other things about when do you step in. So at some point, in the general sense, we absolutely step in. when the price of volatility, and you could look at something called the VIX to see the price of volatility goes up, we know from our research we need to be patient about when to step in. And even though I was not here at this firm during the Great Recession, they were still operating by those principles. So the market had gone down most of the way before they began stepping in. So they were not applying it with the same mathematical formula that I sort of came up with. But when the price of volatility is high, we're going to be very patient about letting it go down before we step in. The variable in that makes it a little bit difficult for some families is so many people have had so many big exits from private equity that they got so much cash on the sidelines, they're ready to buy as if they just had an inheritance or just sold their business. In fact, they sold other people's businesses, right? That we're trying to figure out what to do, because we really, for the most part, haven't gone down enough that we're ready to step in for somebody that just had the more simple public market portfolio. So that's where we got to be careful. Maybe that's where it's the hedged yield, which can be a little bit of a parking space, or some other stuff, might come into consideration. But at some point, if it keeps going down, we're definitely going to be ready to step in. In fact, one more thing. Remember back in the spring of 2020, the stock market just got its legs cut out from under it so fast. We were down 40%, seemed like in a matter of days. We had a lot of conversations as a firm. Okay, here's what the numbers are telling us. Let's get all the advisors together. Let's talk about it. Here's what the numbers are telling us. This seems to be some valid research. This is what we do. We talk about it. We told clients this is what we're going to do. And then all of a sudden we began buying in earnest. And it just happened to be pretty close to the bottom. So for folks that were clients a couple of years ago, they saw it in action. We'd been taking profits. The market just got almost obliterated. And then we began stepping in. And it was pretty close to the bottom of that V. And then it had sort of been a steady climb up until just a couple of months ago. It's this room. It's the private equity investors. They just got 6 times their money back, right? So they're buying homes. No. Well, a lot of people have made money with businesses. There's been a lot of very successful capitalists that are in the top half of the economic strata that have just made a ton of money. It's been a very successful run since we ended the Great Recession, and a whole lot of people have ended up, I just know from personal conversations, with really more money than they ever thought that they were going to have. And then there's all the people that, I've never talked to there. But there's a whole lot of people with money, and the world is awash in cash, where they're just looking to do something. And they don't want it to just sit in cash. So they're just going to go in and be cash buyers of these homes. But there really is just money. Maybe not everywhere, but there's money in an awful lot of places, and an awful lot of it with people trying to figure out what it is to do. What they want to do with it other than just sitting in cash. So, we're just seeing that pressure everywhere. Now, it wasn't that way so much 5 years ago. At that point, we had a year's supply of homes at 750,000 and up. And, that's a few months right now. So much demand. So, if you're at the low end of the economic strata, your problem is rents are going way up. You got no money. You're getting your wages haven't kept up through much of this. So it's you really got to know who you're talking about, where they sit, and it's very different at the top and the bottom. So the question was, how do we think the private markets will do in the face of higher inflation? My belief is this: when we're talking about private credit or private fixed income, much of what we're looking for, much of what we see are floating rate investments. So if the rates go up, there's some kind of peg there, LIBOR, federal funds rate, there's a bunch of different benchmarks. So as rates go up, the yield on the fixed income strategy goes up as well. So you really don't have material inflation risk. Whereas compared to the public markets, there's not that much floating rate stuff out there. Usually the floating rate stuff is the really risky stuff. So I think that'll be fine. On the public equity side, I do think that there is an awful lot of money out there. And maybe inflation, if anything, accelerates the desire to purchase. A lot of the firms that we work with, including our sister company, Panoramic Ventures, is not focused on the smallest companies, but by no means on the largest companies. There's kind of a sweet spot there. And so, again, going back to the idea that the world is to some degree awash in cash, there's a lot of very big firms out there that have huge capital commitments, and they just need something to buy. which is great when you're the one that can sell companies once they graduate to a certain level. And so, if anything, their investors are trying to make sure that capital gets deployed, and so they become even more eager buyers. So I'm not sure that inflation necessarily impedes the performance that you're going to get out of your venture capital and private equity, at least if you're competing in that sweet spot where you're selling into the folks that are desperate to buy something.
Does inflation make REITs more desirable?
I tell you, there's a lot of statistical research about REITs, and the question is, what does inflation do to REITs? Now, REITs are known for their high yields. Sometimes the high yields makes them act like bonds. So interest rates go up, they get tanked. But there's an underlying equity-like asset behind those. So I'm a little nervous about REITs that are focused on Class A office space because so many people can work from home. There's a certain efficiency there. If you're talking about multifamily housing, I don't have concerns there. So what's underlying it is a big part of that. But every quarter when I present REITs, it either acted like stocks or it acted like fixed income, and you kind of never know which one it's going to do each quarter. So it is its own thing, and that's why we have some of it. Long term, it's been productive, but it's a diversifier. It kind of does its own thing. So unpredictable, but at least it has an income statement. And unlike gold and silver, the other precious metals where, somebody come up with a good explanation for what that's going to do, and maybe I'll believe you, but I can't come up with one. REITs do have an income statement. You can value them. So I like them.
So the digital dollar.
The digital dollar, gosh. It's a funny thing. In many ways, the dollars are digital now. If we all emptied our wallets, I don't know how much money we could come up with, but who knows, maybe not even enough to pay for the dinner. I mean, so much of what happens with dollars now, it's just on a computer screen, but it's not digital in its truest form. Yeah. I think we're going through an evolution. There's an advantage to cryptocurrency in some way. I think there's room for a digital dollar. There's room for more efficiency. There's room to get the inefficiencies out of there. There's the value of knowing that a transaction is complete. Right now, if somebody wants to send money and know it's done today, they got to, for the most part, send a wire, a Fed wire as we call it. You're buying a home, it's a Fed wire. Oh my gosh, the paperwork and processes and people involved in that, it's horrendously cumbersome. Well, a digital currency takes care of a lot of those things. The verification of the transaction is inherent in the way the transaction is structured. So I get the value of a digital currency, but we're going to go through some evolutions. Right now we have this thing called a stable coin, where it is a cryptocurrency, but there are assets that are used to stake it. And there was a potential failure just in the past week with one of the more popular stable coins where their underlying investment was Bitcoin. Well, I'm not sure that gives you the stability that you're looking for, because a few days ago Bitcoin was at 40,000, and I think at least one point today it was trading at 30,000. So it's lost half its value in just the last year or so. So we're going to go through a lot of evolutions there. I'm a little surprised, quite honestly, that the U.S. government has tolerated all of this I think they're being pretty darn tolerant. I suspect there's a lot more things that get tracked than we're aware of. There's an awful lot of heists and looting of different parts of that ecosystem that happen that we don't hear of. But you're not the only person to ask about digital currencies, and there's more than 6,000 digital currencies right now. Do we need 6,000? No. And in fact, if the government really steps up its efforts, do we need any of those? Maybe we don't need any of those anymore. I'm pretty sure we don't need 6,000 of them. Maybe we need 10 of them. Maybe we need 100 of them. But if the dollar goes completely digital, and there is a big effort underway to pursue that. Yeah, so we're asking about the stock Micron, and it can be really hard to know what the real story is on any individual stock. Certainly, we like to make sure our portfolios are diversified. But I think the core question there, if this is a stock that does the thing that's in great demand, why is it down? And one of the bits of math that we do with investing is we can calculate, after the fact at least, how much any stock just acts like the market. So most stocks just depending on the time frame. We'll find out after the fact, 60 to 70% of their performance is just whatever the broader market was doing. So there's always exceptions. The market goes down, some stock goes up, or vice versa. But a lot of how stocks move is just what did the broader market do. And some of that is because of the amount of indexing that takes place these days. And there are people that will argue that the amount of indexing going on right now is actually harming the markets. Meaning, if Micron or any other stock is part of the S&P 500 or some other broader index, if the index is selling off, that gets hurt too. So if you're Vanguard or BlackRock or iShares or whoever, and you run all these indexes and the markets are going down, you're forcing down all of these other stocks. And we're losing the ability of individual stocks to perform as their fundamentals would suggest that they do. Now, indexing is a lot bigger than it was a few years ago. And I will say that for the most part, people that index do better than people that pick stocks. And that's just been observed. And it just has to do with cognitive flaws and how humans make decisions and all that. But the rise of indexing at some point means that most of us are just buying the market. Well, somebody's got to be discovering what's the fair price of an individual stock and reflecting those fundamental advantages or disadvantages. So I don't know if we're really at the tipping point yet where we can't count on individual stocks to react the way they should. But this rise of indexing, while generally helpful, causes people to be diversified, might be contributing to some of that. And at some point, maybe when it's gone too far, we'll realize that. So the question was, is there a strategy around, say, dividends, for instance? Well, I mentioned that we have a value tilt. And we always have. I'll call it a semi-permanent kind of a thing. We'll vary our numbers from year to year a little bit. But this belief in value is a persistent belief that cheaper stocks for the amount of earnings that you get is a key to longer-term outperformance. Now, dividends are either the cause or the effect of why that happens. We're not 100% sure. But when you have a value stock, you're paying less for the earnings behind it. You also tend to get a dividend. Not always, but it's again, maybe it's a natural byproduct or maybe it's the cause of the outperformance. So our portfolios have a higher dividend yield than if you just Vanguard your portfolio. So again, is it the fact that the stock is typically cheaper or the fact that there's that cash flow out of it? People that know that this is the long-term phenomenon that value outperforms if you get into multi-decade analysis will argue whether it's the dividend or not. So we don't know. It's undecided. But it is a byproduct of the way we invest, and the dividends are higher, and we're happy that for the most part receives long-term capital gains treatment, because when it didn't, seemed kind of unfair. So we hope that part of the tax code stays the same. But yeah, maybe that is the reason that value stocks do better, and we're glad that we do it. Are we in the secular bull market? Well, I went out on a limb at the beginning of 2021. I went out on a limb at the beginning of 2022. At some point, I need to cut my losses and say I chalked up a couple of wins and just stop making predictions. The stock market on many days for many years seems like the most proficient engine ever designed to make seemingly smart people turn out to be pretty stupid. So when we make predictions about what it's going to do, it's really easy to get that wrong. What I do think, and again, are we in a secular bull or maybe it's bear market now? One good piece of news out of China, one good piece of news out of Ukraine, and every narrative and emotion we have about what the stock market is doing this year could flip. Now, it could get worse. I mean, you read some of the potential bad things that could happen in Ukraine. Maybe tactical nuclear weapons get used and then, forget it. So I do think that there's fundamental news events that are likely to overwhelm things for either good or bad that are unknowable as we sit here today. What I know right now is we've got a big inflation problem, and China could potentially cure that, and Russia could potentially cure that if those situations settle, because we'll get back to more globalization. That's deflationary. We unstick the supply chain, and then it's a completely different narrative. Are we going to get that news? I don't know. So I'm going to go back more to those fundamental causes and say, we'll see. If it all just keeps going like it's going, I think we're going to continue to see a lot of pressure. But I call that the new math. We're in a situation that, again, a lot of investors here haven't ever really invested through before. And the hedge funds, the other big players are doing new math. What happens when the Fed has let inflation get this far out of control? They're running equations now that were only theoretical for them in business school. And one day the Dow's up 1,000, next day it's down 1,000, and that could become 2,000 or 3,000 either direction while they're trying to figure it out. So it's a very unknown thing, and that's why the VIX, the price of volatility, is running at about double its long-term average right now. The market is saying, we don't know what the heck's going to happen. We don't know what the heck's going to happen. It just could be wild swings in either direction. So volatility is really the prediction more than directional.
So Eric, we're closing in on 9 o'clock.
Okay.
So maybe one more question.
Okay.
If there's one.
Somebody asked me a question about vehicles. Should I talk about cars for a minute? Because that's come up a couple times. I think you had a question about the cars. I think you were trying to figure out are EVs like a good investment. You know, it's a funny thing. There was an article that came out just a couple of months ago. I think it was with Edmunds that said if you happen to be that person that did a 3-year car lease 3 years ago, and your car is about to come off lease, on average, it's worth $7,500 more than the buyout value on that lease. I think especially if it's gas. Because try to get replacement batteries right now. The EV market is shifting towards decent but less storage capacity in the batteries because it's a cheaper technology because they can't even get the raw materials to reliably supply that. So Tesla's already made the change in China. We're going to see that in other vehicles here. So it won't be the typical lithium ion. There'll be sort of tiers of EVs because replacing the batteries are already horrendously expensive, but now you can't even get the materials to make them. So there's a lot of disruptions there. But the car market is really interesting. Cars typically, unless it's that rare Ferrari or something, are going to depreciate in value. But in an inflationary environment, the car acts like an asset. It doesn't act like an expenditure. It doesn't act like a consumer good. And the thing we said earlier is when there's inflation, instead of less purchases, when something gets more expensive, when it's treated like an asset, when it gets more expensive, it increases the demand for it. So I don't think cars are going to get cheaper anytime soon. I think the pent-up demand for cars is going to last for years before that supply can be provided by the market. So for the moment at least, I think cars are an asset that's likely to appreciate. I mean, they do wear out, but on the whole, you know, if you can find the car you want, it might not be a bad time to buy a new car. Hard to say. Again, if we unstick the supply chain, some of that inflation goes away, they could be the worst. So I think it's probably kind of binary. And with that, thank you for coming tonight. I'm going to hang around for a little bit more. You all were a great audience. Thank you.